how to analyze a rental property. We're going to go super, super in depth. We're going to be focused on the market of Cleveland, Ohio, obviously a market that Mike is an expert in, a realtor in, a market that I've invested in as well. So you have two people experienced with investing in Cleveland. We're going to pick a property that's on the market right now, on Redfin, on Zillow. Mike and I are going to talk about the pros and cons of this particular property. We're going to talk about Cleveland at large, right? How to think about investing in Cleveland. What are the areas that Mike recommends focusing on? And then we're going to pick a property that's literally on the market right now. And Mike and I are going to live analyze the deal. We're going to pull up a rental property calculator, the one that I built. We're going to plug in some numbers. We're going to analyze all of the metrics, all the cash on cash return. And then at the end, we're going to say, is this a go or no go? And we'll kind of like summarize all the different aspects. So this is a very tactical episode. Another thing too is we are going to be sharing our screen. We're going to be pulling up the map of Cleveland. We're going to be pulling up the rental property calculator. Let's just hop right into the topic for today. The first thing I'm going to do is I'm going to pull up a map of Cleveland. Okay, Mike, so all I've done is I've gone to redfin.com. It could be Zillow, doesn't really matter. I prefer Redfin. I just like the interface a little bit more, but you can use Zillow as well. All I've done is I put in Cleveland, Ohio, the market that we love and know, and I just have for sale properties. So we're looking right now, all the properties that are for sale in Cleveland. But the first thing we're going to do is we're going to, Mike, filter down to our buy box. And for the listeners right now, if you don't know what you're looking for, Mike, right, you're never going to find it. Let's talk a little bit about, for the first time buyer in Cleveland, what is a buy box that typically makes sense for them? And we'll just kind of chat about that, and then we'll input that directly into the search. So Mike, what is a typical buy box that you kind of recommend?
So it will vary a little bit. Typically what I will do is it's going to be based on how much capital that someone's willing to deploy into the market. One of the reasons I ask those questions when I'm doing my consultations with people is understanding one, their risk profile, how much they're willing to spend, because that enables me to kind of direct them. And here's a good example with some numbers. If someone comes to me and says, hey, I want to buy A or B class multifamily for $250,000. I can quickly ascertain that that's just not going to happen in our market.
Elaborate a little bit why.
We don't really even sell much in like what I would consider to be an A area, right? An A area for me is going to be very suburban and it's going to be very expensive, right? You're talking about the best school districts, you're talking about the best amenities, and you're just not going to buy properties like where I live, for example, is an A class community. I live in an area with one of the top school districts in the entire state of Ohio, and you're just not going to find investment properties in my area that make a ton of sense.
Mike's a little bougie.
I'm a little bougie. Yeah. But that being said, what you have to do is you have to kind of get people to understand, because the neighborhood grading is also very, very subjective, right? There's no clear-cut criteria to determine what is an A class, a B class, a C class, and the D or worse, right? I have my own feelings on what that looks like. A lot of it surrounds schools. I get that theme a lot from people. That's part of it. Part of it's going to be areas where you feel safer. Part of it's going to be maybe neighborhood amenities, like what's going on in the neighborhood. Is there restaurants? Is there nightlife? Are there jobs? Do people want to live there, right? So neighborhood grading, very, very subjective. Let's just use Lakewood, Ohio as an example. Lakewood, to me, very solid B class area or better, depending on which side of Lakewood you live on. But Lakewood's a very hot area. The typical 2-family in Lakewood sells for between $300,000 and $400,000 right now. So, so if someone comes to me and says, hey, Mike, I want to buy multifamily and I want it to be B class or better, and I want it to be $250,000 or less, that's going to be very difficult to achieve.
Yep.
So that's why I always kind of start with, let's start with the end in mind and reverse engineer what we want to do. So for that person who comes to me and says, I want, to buy that, I might then suggest we look for a single family in a nicer area, right? Because you could buy a single family in some of these B class areas, and it would probably fall in a, say, $175,000 to $200,000 range. And something that's going to be in a better school district, and it's going to have a good renter pool, and you're going to have a strong price to rent ratio. So there are different tactical ways you can go about it.
Absolutely. So I think everything that Mike said is very important for you, the listener, to understand. You have to come in with the right expectations. Just because Cleveland is a lower price market than maybe some other markets that you're used to, you have to really calibrate your expectations and your goals. So like Mike is saying, you want to be in the best school districts, in the best neighborhood. You're just not going to find a multifamily property that's going to be $250,000. Now, if you have the right expectations and you come to Mike and say, look, I understand that Lakewood is going to be a nicer area. I understand that I'm going to be probably trading off cash flow for maybe more appreciation, and I'm okay with that, and you come with the right budget, then Mike certainly can help you find maybe a multifamily property in Lakewood for 400 to 450, right? And so there's expectation setting. But for the purposes of this call, Mike, I want to go ahead and say, let us focus on a price range. I'm going to say 150,000 as a minimum, 150,000 as a minimum to 200,000 as a maximum, right? And so for me personally, I like to have a buy box that is fairly tight, like I think there's probably different schools of thought here. Maybe you want to have a wider buy box in terms of 100K so you see more deals. But for me personally, I like to have a pretty tight buy box so that I get really used to seeing the types of deals in that buy box and understanding the quality and just get really used to seeing that, because there's a vast spread. You can go to 100K, Mike, in terms of like the difference, and you're going to see so many different properties. So for me personally, I like to keep the buy box tight. Now, Mike, I personally like to have a floor here, and I like putting in a min because I find that when you kind of go below a certain point in Cleveland, and maybe you can speak to this a little bit more, you just might be seeing properties that might seem tempting on paper, but they just might not be the properties that you want. And so for me personally, I just like to set a floor. And I've been looking at properties in Cleveland long enough to know that I just don't like what I see most of the time when they're below that kind of 150 threshold. And for me personally, that's where I like to live. But maybe you can comment on that in terms of like, people probably come to you all the time and say, hey, I want to buy a $90,000 house in Cleveland and I want to cash flow a ton. But the expectations, again, might not be aligned there.
Right. Yeah, no, the 150 number is a good number to start with, especially for those that are looking multifamily. In my experience, in the neighborhoods where a vast majority of our investor clients are investing, you're going to be somewhere in that $70,000 to $80,000 per unit price point. So if it's a duplex, 150 to 160, and you can do the math from there. So, and that's kind of it's kind of the floor. And you'll see, I mean, anyone can get on Zillow or Redfin and pull up these properties at different price points and thumb through pictures, and they'll figure it out pretty quickly on what they're looking at, and they can see. And so you'll figure it out quickly that you're at that's a good price point to start.
Yeah. And just to kind of talk through, if you're listening on the podcast right now, I'm in Redfin. One thing I did, Mike, while you're talking, is I actually removed the Cleveland filter, just because, as you were talking about Lakewood is technically not in Cleveland, Ohio, right? And there's a lot of suburbs around Cleveland. So just for you, the listener, to be aware, there are a lot of suburbs surrounding Cleveland that you might want to invest in. So if you're filtering on Cleveland, Ohio, it's technically, depending on the platform, it's going to filter out places like Lakewood, like Parma, like Akron, and things like that. So just for you to be aware, I removed the Cleveland filter just so that we can capture kind of the broader area. So, okay, cool. We've dialed in the buy box of 150 to 200K here, and we've gone from 1,000 properties on the market to just 300 now. So we're already filtering down what we're looking for, and this is exactly what we want, right? We don't want to be looking at everything under the sun, because it's going to take a lot of time to obviously analyze all those properties. So the next thing that I want to go to, Mike, is the home type. So Cleveland is a market that you can get, a single family house, and that might be your strategy. You could also be small multifamily. That could be what you're hoping to accomplish here. For the purposes of this call, and I think there are merits to both single family and multifamily, Cleveland is a great small multifamily market. So for the purposes of this call, Mike, I want to dial in on multifamily. So okay, I'm coming into the home type filter here on Redfin. And again, this is all part of the buy box, people, right? You have to have this dialed in. So when you have your first conversation with Mike, you know exactly what you're looking for. I want 150 to 200K multifamily. And so we're selecting that right now. And look, we've already dialed down to 47 homes. So just filtering on price, just filtering on multifamily, We're now down to 47 homes in Cleveland that fit the 2 criteria that we have so far. So we'll kind of keep going because we're not done with the buy box here. The next thing that we want to do is specify, obviously, the bed and bath count. So if you're talking about a multifamily, this is pretty straightforward. But for me personally, Mike, from what I've seen, you have a lot more success in multifamily when the units are at least 2 bedrooms or more. The single bedroom units, I think you probably have you have a more transient tenant. You probably won't get them to stay as long. And I just find that it's probably better to have at least a 2-bedroom unit. So if we're talking about multifamily, I'm looking for beds of at least 4 or more, because if you have a duplex, let's say that, right? You have 2 bedrooms on each side. It's at least a 4-bedroom house. So all I've done here, folks, is I'm just specifying that I want to rule out, because I've already selected multifamily. I want to rule out any multifamily that is just single bedroom units in the multifamily property, right? And so that's what I'm doing here. See what that does. And it only filtered out 1 house. Or it filtered out like 3 houses there. So cool. Mike, this is where we are going to play in terms of the properties that we're going to pick to analyze. And we're probably only going to have time to do one because we're going to go super, super deep here. Another thing to point out for the listeners, right? There is more to the buy box that you can play with. And we're not going to dive super deep into this, Mike, but you might have some opinions on what the square footage might be, right? You might have some opinions on, you want to filter for air conditioning. Maybe you do want a basement, all this type of stuff. Or another thing that you can filter for is a year built, right? Maybe you don't want a property that's built in 1900. Maybe you want to focus on properties 1960s or newer, right? Just different things like that. So I'm just pointing out to the listener that there are different things that can construct a buy box. You don't want to get too focused on the filters here, because you might actually miss things that could work for you. But I just want to point out that there are other things. And so that's all the buy box is, folks. You're just specifying the criteria of what you want to look at. And then you put that into Redfin. You set up that automated search. Mike is also going to set you up on the MLS for an automated search. He's also going to do a very similar thing, setting your buy box in. But you want to get this deal flow. You want to be seeing these deals. You want to be an expert on these deals, so that when the deal comes up and it's the one, it's because you've looked at so many deals that fit this criteria that you're going to be an expert, right? So that's kind of what we want you to get to, is to be really comfortable with your buy box, so that when that deal hits your inbox, you already know it's the one, and you'll be the first to offer on that property because you've seen so many like it. And so that's what the competence that we want you to get to, so that you have more confidence pulling the trigger. Because Mike, as we found out, right, speed to offer is a critical component of landing the deal. And every single deal that I've gotten, specifically in Cleveland, I was probably one of the first to offer on that property. And that just goes a really, really long way. So don't discount speed, right? But you can't get to that speed to make that offer unless you have the confidence to analyze the property, which Mike and I specifically are going to talk about. And so, Mike, now that we have the buy box filtered down, I want you to speak a little bit on, okay, I'm looking at this map, right? It kind of spans from the west side of Cleveland to the east side of Cleveland, all the way down to kind of Garfield Heights and things like that. And so when you are, you obviously counseled me in the very beginning that you want to focus, you likely want to, there's a big difference between the east side of Cleveland and the west side of Cleveland. So I want you to talk a little bit to the listener. Maybe they're not as familiar with Cleveland, but talk about the geography of Cleveland.
There is a divide of Cleveland. You have east siders, you have west siders. It's just the way it goes. And you have, and that can be that way for investors too. People who like west side, people who like east side. The areas that have seen the most investment and the most appreciation in, say, the last 3 to 5 years has been predominantly on the west side of Cleveland. It's closer to the airport. The infrastructure is a little bit easier to navigate on that side of town in terms of interstate highways and things like that. And you haven't seen as much of that on the east side. However, we are starting to see some nice improvements on the east side. I was actually driving through an area of the eastern side of Cleveland recently, and what used to be one of Cleveland's largest housing projects, I didn't know it because I hadn't read about it, but they're actually tearing it down and they're going to rebuild it. So that's awesome, right? Those are the types of things that we need to see in an old Rust Belt city like Cleveland, like Detroit, some of these Midwest cities and towns where our properties are very old, right? So we need some of that revitalization. So, driving through some of these areas of both sides of town, I'm really happy to see some really nice growth and revitalization.
Yeah, absolutely. No, like love to hear that. Love to hear that. Obviously, as owning property in Cleveland myself. And so, to be very tactical for the listener and for those that are geographically challenged like myself, when we're talking about the east side and the west side of Cleveland, a thing that was explained to me that was very helpful is that if you look at downtown Cleveland here, right? And I'm pointing right now at the map again for those listening on the podcast or on audio. I'm pointing at a map of Cleveland. If you go downtown and you draw a line straight down, everything to the left of that is going to be the west side of Cleveland. Everything to the right of that is going to be the east side of Cleveland. So from a very tactical standpoint, that's like a way to just kind of divide the map.
Yeah, you can use, most people use like Interstate 77 as the divider.
Okay. Interstate 77 right here. So on the left side of Interstate 77 will be the west side. On the right side is going to be the east side. So that is very helpful, right? That's just a helpful nugget. And whether you're investing in Cleveland or whether you're investing in, I don't know, Kansas City, Louisville, Kentucky, whatever, there are going to be nuggets like that of maybe it's not east and west, but maybe it's north and south, or maybe it's like particular neighborhoods, things like that. That's the type of knowledge that you have to really lean on your investor-friendly agent for, right? Because you're not necessarily going to know that as somebody that is an out-of-state investor. And so these are nuggets that are just extremely, extremely helpful. And if you didn't have a person like Mike, you might just randomly pick a property that is just like in a terrible area that you're not going to know. And despite the numbers working well, you just don't want to be in that area, right? So anyway, I think that's very helpful. Thanks for talking through that, Mike. So now we're just going to dial in. I want to say to further, continue to filter down the properties, which is what we're trying to do there. I want to say we actually just want to zoom in more on the west side of Cleveland, right? Because that's what we're trying to do, ladies and gentlemen. We're really trying to become experts, not just on a market, but on particular areas, right? Particular areas so that we know exactly what we're looking for. So I'm taking, for all the listeners that are listening on audio, I'm taking the map of Cleveland and I'm zooming in to the west side, right? So I'm zooming into the west side here, and now we're looking at 19 homes, Mike, 19 homes. And I already know that Mike knows all of these homes, obviously being an expert on this market and understanding what is on the market right now because he has clients that are looking for deals actively. So Mike, we're looking at a map of the west side of Cleveland right now. We're looking at about 17 to 19 homes. You know Cleveland very well. I want you to kind of direct me because they're all kind of, in the buy box that we have. We have 165 all the way up to 195. So Mike, I want you to tell me which one should we kind of like take a closer look at here based on your knowledge of the neighborhoods here in the west side.
What's the one over there that's lit up red? It's over probably west 140th, west 150th.
Yep.
Yeah, that one. What's that one?
I have clicked on the property that Mike is suggesting. It is 3686 West 130th, Mike. It's listed for $190,000. And it is a 4-bed, 2-bath duplex, which means that each unit is 2 bed and 1 bath. So, Mike, what I'm going to do here is the first thing that I like to do whenever we kind of pull up a property that we like to analyze here. And Mike, let's back up before we dive into the property specifically. Why did you pick that property specifically as the one that you want to look at first?
I wanted to see what it was because we're looking at a 150 to 200 price point. And the further west you go in Cleveland, traditionally the prices kind of go up. And the fact that one was pretty far west and it was under 200K, I was intrigued.
Okay. That's great. So we've pulled up that property now. And again, like a great nugget for you, the listener, to understand. That's a little bit of insider baseball, right? That you don't know necessarily if you don't have the investor-friendly agent. That's kind of suggesting the things to you. So we pulled up the property. The first thing that I always like to do, Mike, as somebody that is out of state and that hasn't necessarily doesn't know the streets and everything that well, is I like to pull up the street view, right? And so I'm pulling up the street view right now on Redfin, and I just like to take a little gander, right? And so we pulled up the property. What I'm kind of noticing off the bat is, okay, so we do have some homes here that don't look in the best shape, but all around, I think this is a nice blue collar neighborhood. We have some single family houses and things like that, taking a gander. So overall, I think that it looks decent. I would say it's not the cleanest kind of street view, but overall, do you have kind of any concerns on this, and do you feel like this is typical of what you'd find?
Yeah, so 130th is a busy road, right? So if someone were to reach out to me and say, "Hey, Mike, tell me about this property," I would say, "Well, West 130th is busy. So as long as there's off-street parking, because that's going to be a concern for your tenants, we'd want to make sure that there's plenty of off-street parking. Now on 130th, you can. I don't know the restrictions off the top of my head. I know you can park on the street some hours of the day. I think there's restrictions and stuff. Now, obviously, that one house that's next to it looks a little rough. So I would be concerned about that property there. Because I'm looking at the pictures on my other screen here. So it's a little bit easier for me to see. And yeah, it looks like it's boarded up. So that's,
Yeah.
Obviously that's a concern, right? Because if you're going to get good tenants, they're not going to want to live next to a house that's, boarded up or, got squatters in it or something like that. So hopefully whoever owns that property is in the process of fixing it up. Right. So, in this instance, I may even do a quick dive into that property next door to see like, hey, when was the last time that thing changed hands? If it was just sold 3 months ago, then there's a good possibility that the current owner is going to flip it or fix it up and fix the rent. If it hasn't changed hands in 20 years, we know that that's a pretty shitty landlord there or homeowner that owns that property that they let it to fall into that kind of disrepair. So
yeah. So this is all very, very valuable commentary, ladies and gentlemen, that kind of Mike and I are having right now. And it's the type of commentary that Mike would have with you, should you be his client and things like that, because it's all very helpful, right? And so for me, I've always liked taking the street view. I've always liked, and be really honest with yourself, guys. Like, look, to me, Mike, I'd probably call this, based on the street view and probably based on what you're saying, the knowledge, this is probably like a C class area, just eyeballing it and things like that, right? So you as a listener, you gotta be okay with that. Or if you're not okay with that, right, then you say, okay, cool. This, just the feel of it, the look of it, I don't really like it. I don't really like the boarded up kind of aspect of it. And so you kind of move on, right? But this is the type of at least eyeball view. So let's go ahead and look at the rest of the photos, Mike. I think you always have a lot of very valuable commentary in terms of with your experience as a flipper and obviously your experience as an agent. Would love to. And I know you're flipping through on your computer as well, but does anything jump out to you?
First thing I'll point out is this property doesn't have a basement. So it doesn't have a basement. So it's kind of almost like a garden style apartment there. It looks like on the first floor, right? So you've got that. That's no big deal. A basement is whatever. Not that big a deal. I've thumbed through the photos here on my computer and I see what looks like quite a bit of off-street parking. That was one of the first things I had concerns with. It looks like a nice yard. The exterior photos, it looks like vinyl siding with the brick facade. The current owner has done a nice job cleaning up the landscaping, so it looks pretty low maintenance. So that looks solid to me. Unfortunately, the roof pictures, it's really hard to see what kind of condition the roof's in. So, but the home inspection will help us with that. So, going into the interior photos, so it's steam heat. So you do have a boiler versus forced air furnace. So, that's one thing I'll point out. Boilers are a little bit more expensive to replace. They're pretty efficient. They're pretty efficient as long as you can. And this one's not an older unit. Like it's not like this massive, 1940s boiler that I've seen before. So, but our home inspector will run through that, run it and make sure it works properly, things like that. So, it does look like it's been updated. I'm not going to say it's been like extensively rehabbed, but it's definitely updated for the level of finishes. The other thing I do like about this property is that it was built in 1973, which is newer for those. Newer for Cleveland. That's new for Cleveland. And why is that important? This property won't have any knob and tube wiring in it. It'll have modern plumbing. So it just doesn't, it won't have a lot of the defects that we run into in the really old properties. So that's always good. So so those are some positives. And then thumbing through the rest of the photos, yeah, it looks really clean. Fresh paint, fresh carpet, vinyl flooring in the kitchen. Nice, looks like newer cabinetry. Those are definitely not 70s cabinets, right? It's got appliances, which is nice.
Where would the washer dryers be if there's no basement unit for each of the units? So there's a separate washroom in each of the
Yeah, so the likely scenario in this property is that there's a utility room in each unit that houses the boiler and the hot water tank. Yep. And then it has a laundry hookup. So it's hard to say exactly because this agent didn't provide us. I don't think we've been provided photos of both units. One of the units is actually occupied currently. The other one's vacant. So okay. I'm guessing that we don't have pictures of the occupied unit.
Okay. Another thing I'm noticing too, Mike, is one of the bedrooms at least looks fairly small. And so I'm just kind of pointing that out because when you're thinking about your end buyer, your end tenant, that's something that they're going to take into consideration as well, right? Is the size of the bedrooms. And I have a property similar to this where one of the bedrooms is actually quite a bit smaller than the other one. And it's really just a couple that uses that as an office, right? So you have to think about, am I truly going to have two people that are living in each of these bedrooms, or am I really just having one person that's using this as a one bedroom, one office type situation? But that's another thing that I noticed, Mike, is that one of the bedrooms does look a bit smaller. At this point right now, Mike and I have just had a very qualitative conversation about the area, about the street that it's on, about the property. And this is the type of conversation that you should be having with your agent, the pros and cons, what Mike likes, what he doesn't like, and things like that before you even run any type of numbers, right? Before you run any type of numbers, you want to get comfortable with the quality. This is all things that you need to get comfortable assessing. But for the interest of time, let's say that we wanted to move forward with this deal. And best believe, folks, maybe this deal isn't a deal that Mike and I would move forward with, right? There's a lot of reasons that we may or may not want to go forward with this deal. But for the interest of time, Mike, let's say that it's past our qualitative assessment. It fits kind of our criteria. And we actually want to move from a qualitative assessment to more of a quantitative assessment. And so we're going to go ahead and move forward with this. Let's say that it's kind of past our sniff test, so to speak. And for the listeners, Mike's sniff test is very strong. He will not let you analyze a deal if it doesn't kind of even past the very basic assessments of what Mike would want to get in out of a property. So, but let's say that it passes sniff test, and let's kind of move forward.
I do like the property as an aside. Okay, I do like the property. I like the fact that it's built in 1973, straight off the rip. So you got the modern construction, those types of things. Obviously, I do, like I mentioned, I have concerns about that vacant property next door. But what really is attractive to me on this one is the fact that they do have a tenant in place in one of the units, paying a pretty good clip.
What are they paying?
They're paying $1,050. So for a 2-bedroom unit in Cleveland, that's about 900 square feet, 950 square feet on this building per unit. That's a pretty good rental number. That's a really solid rental number. So that's the other thing that has me thinking, okay, this is probably worth at least doing a deeper dive on.
Yeah. Okay, great. So, just off the first property we picked, right? It's passed a sniff test for Mike. And now we're going to the next phase of this, which is we are going to actually analyze the deal. And this can take a lot of time, but Mike and I are going to probably go through this very quickly. Again, very much encourage you guys, if you're listening to this on the audio, to go on to YouTube and watch this on my channel at Cashflow Saga, because you are going to be able to see the rental property calculator that I built. The rental property calculator is also available for free download. So we'll put this in the link in the description. You can download it for free. It's a great tool. I use it for every deal that I analyze. But Mike, we're going to now transition to the analysis of the deal specifically. So we're now looking at the rental property calculator that I built. It is a spreadsheet, and I've tried to make this as organized as possible. And all we're going to do, right? Analyzing deals, I think, can scare a lot of people, especially if they're not really oriented into numbers. But Mike, all we're doing here is plugging in some numbers. The calculator does a lot of the heavy lifting. All we're going to be doing is plugging in some numbers. So first thing I like to do, Mike, is I just like to take the address of the building, and I just like to plop that into my rental property calculator here. So we're talking about 3686 West 130th Street, Cleveland, Ohio. The purchase price, I believe, was $190,000. Built in 1973, was it, Mike? 72, 73, 73. And the unit count, it's a duplex. So we're talking about 2 units. So we're looking at roughly $95,000 a door. And for all those folks, the only reason that's, really important is because what we try to achieve, at least in the Cleveland market, where we can, is the 1% rule, right? And so we already kind of know a teaser here is that one of the units is rented for $1,050, right? With a price per door of $95,000, that's already kind of hitting or surpassing the 1% rule threshold. So that's just a little bit of an aside. So Mike, now we're moving on to the financing. For the listeners here, you obviously are going to need, most likely, if you're not paying for this in cash, you are going to need to take a loan. And what we know about the Cleveland market, and not the Cleveland market necessarily, but when you're buying multifamily property, the lender highly, highly prefers for you to put a 25% down payment on a multifamily property versus 20% or less. And so what we're going to assume here is that you're putting a 25% down payment on this property. Mike, I know the rates are coming back down to us, and so the loan amount here is going to be $142,000, and the down payment is $47,500. So we're already at $47,500 in terms of the amount of cash out of pocket here, but we're not done. The down payment is not the only thing that you're going to need to have. Mike, for the interest rates, I don't know if you know what the rates are today. I think they're probably in the low 7s, I want to say.
So I'm actually, you're creeping into the high 6s now. So
okay,
but for this example, I just throw 7.
Let's go 7. So 7% right now, and the rates are coming back down to us, obviously. But Mike is seeing things in the high 6s as well. The other thing I want to point out is the rates are different for residential, like for, if you're just buying it to occupy versus if you're an investment property. So you should assume a little bit on the higher side, unless you know specifically from your lender what the investment property rates are at. But right now we're going to assume 7. And then, so the next thing here, so loan term, 30 years, most residential properties, you're going to get obviously a 30-year fixed rate on your loan. So just putting in the loan term there. Closing costs, Mike. So what I have put it here in terms of closing costs, this is a percentage, obviously, of the purchase price of the property. In my experience, Mike, what I typically see is this is usually around 3% of the kind of total purchase price of the property. So this can vary. Obviously, it can be less, it can be more, but I like to put in 3% here. Do you agree with that, Mike?
I do. I was going to say 2.5 to 3 is what I typically see. Yeah, because there's going to be points and fees and title charges, and so yeah.
Yeah. And so, and folks, if you're buying a rental property for the first time, this is usually something that catches a lot of first-time investors off guard, is that there are more costs than just the down payment, right? And so for this one, putting in 3%, your total cash invested goes from 47.5 to 53,000, right? So if you didn't have that 5-6K to toss into the deal, you're already kind of on the back foot, right? So this is another reason why the rental property calculator is helpful, because it's factoring in the closing costs. Now, another item here that I have, Mike, is repair costs. Looking at the property from the pictures and things like that, it does look pretty clean. But Mike, what I always like to tell people, and I know you're a big proponent of this as well, is don't assume that you're not going to have to do anything to the property to get rent ready, or at least assume that you want to have a little bit of reserve. So for my money, I always like to put something in here. Even if it's $4,000, $4 or $5,000, I always want to put something in here and not assume that I'm not going to have to spend anything on the property. So Mike, you want to talk a little bit about that in terms of the reserves, or the assumption that they're going to need to do a little bit to get a rent ready?
Yeah, absolutely. So in this example, I think we're pretty close to rent ready. Obviously, the one unit up is rented. The second unit, we see the pictures. Nothing is jumping off the page at me that would be in need of an immediate fix. The other thing too, and this is another little nugget for people, while you were talking, I looked up the current owner of the property. She bought it 3 years ago with an FHA loan. Why is that important? It's important because FHA, as we all know, is a house hack loan, right? So the woman who owns this property used to live in it, or at least she bought it to live in it. Typically, owner-occupied properties are nicer and more well-maintained than properties that are done by investors, right? So those are more reasons why I think the property's in good condition. However, I think you should always fund a reserve account to begin your journey. So for me, given everything that we've seen in this property, what I know about the property, what I've been able to ascertain, I would probably just put a $5,000 number in that.
Yep. Agreed.
To start with.
Agreed. And folks, we also at this point, we don't know, and we'll know more, right? Say you wanted to put an offer on this, Mike would obviously, him or someone from his team would obviously walk that property, take video, take pictures, get a look at the occupied unit. And so you can put a more educated number in here once you know a little bit more. But I always would counsel to put something in here just to be prepared, right? And so now are kind of taking all of that into account. If you just assume you just had to put the down payment, then you're talking about $47,500. But with the closing costs and the reserve account that we're talking about funding here, you're now jumped up to $58,200, right? So we're talking about 10, 11,000 more than just the down payment. And so this is what I want to hammer home for folks. When somebody says like, hey, I have $50K, Mike, for a down payment, Mike is going to tell you, no, you don't. You have $40K for a down payment, and then you have $10K for closing costs and reserves and things like that, right? So that's a very important point. So at this point, Mike, we've already filled out the financing details, a little bit of the repair/reserve budget. And now we're going to come into kind of the bulk of the underwriting or deal analysis here, which is the income and the expenses. So what we have to do here, Mike, is we have to estimate what the property can do in terms of income. And then Mike and I are going to go through a very detailed assumption on what the expenses for this property are going to be. And this is the nuts and bolts of it, folks. Rental property math is not very complicated math, but you have to do the math and you have to make sure that you're in a good position to be able to, hold this property for the long term. That's all we have to do here is hold this property for the long term and see what the cash flow is. So Mike, we'll go to the rental income first. We already have a little bit of a teaser here in terms of what the property can do in terms of generating the income because one of the units is occupied. But what I always like to do, Mike, is I like to take just a gander at what rentometer.com actually says. And just for the listeners, I'll tab over to here. Rentometer.com is a site that obviously just aggregates rental data, and it's quite handy. So I would definitely recommend it to anybody. I've used it a ton, and I think it works great. All you do is just plop in the address here, right? It's going to recognize the address. You're talking about, a 2-bed, 1-bath unit. We're just talking for the unit rent, and we'll just multiply that by 2. This is very important. I always like to select apartment. Single family houses will always have higher rents than a duplex because you have the whole property. It's typically larger, and they're going to pay a premium. So even if it's a 2-bed, 1-bath house, Mike, that single family house is going to garner higher rent than the apartment building. So I don't want you to select house and actually get overly optimistic with what the building is going to do because of the fact that you did not filter out the single family houses. So that's another important nugget that I've learned kind of when in doing my deal analysis. And then all we're going to do is check the rents, right? So let's see what rentometer.com says for this particular property. Okay. So this is interesting, Mike. This is interesting because based on what Rentometer is saying, they're saying that the average rents in that geographic area is actually $930. Right. And what I like about Rentometer is it's telling you different things. It gives you the median, gives you the 25th percentile, and it gives you the 75th percentile. The reason why this is interesting is we already know that we're exceeding these projections here. And so we already have a proof point that this property can do better than what Rentometer is saying. And this is an important point because, one, this is data. Right. And you can't just blindly trust data either. I think Mike has seen different instances where the data doesn't really make sense. Actually the data skews too high. And Mike's saying in no world is this going to do what Rentometer is saying. Or this is actually, I know for a fact it's going to outperform this. So this is another instance of that. But I do like to pull it up as an option because this is something you can validate with Mike. And so what I'm going to do here, Mike, is because we already have a data point that proves that this property can outperform these Rentometer estimates. I trust it enough to say, look, I think we can probably do 1050 on each side and do 2100 for the total property. But I just wanted to show that to the listener that you can at least get a good starting point with rentometer.com and you can refine based on, what your realtor thinks And at this point, you maybe have a property manager that can validate that too as well. So you can triangulate all of these, but this is very important because you should not be too optimistic. You also should not be too pessimistic because you can miss out on a good deal if you're too pessimistic and you assume that this property can only do 850 when in reality, it can do a lot more. So I just wanted to show that, Mike, but I think we have enough data with one side rented that we can actually say that this property does 1050 each side or 2100 in total rental income for the month, right? So now that we've got rental income, we have to talk about the expenses now, starting with the property taxes. Mike, so this is an area that I think a lot of rookie real estate investors will get tripped up, right? Because they do not assume that their property taxes are actually going to go up, right? And so this is where I actually think it's very important for the listeners to, sorry, I'm tabbing through here. And usually Redfin shows the tax history. It's not showing it right now. But anyway,
I want to talk about, so you're good.
Okay. So the property taxes, folks, are important because obviously the the previous owners are going to be paying a property tax, but depending on the state that you're in, property taxes are reassessed, right? And they might be reassessed upon sale, or they might be reassessed on specific time intervals. So you have to know that. You have to know that because when you're buying it, you're likely buying it at a premium from when the previous owner bought it, and it's going to have a new assessed value, which means higher property taxes. And if you don't assume that your property taxes are going to go up, when they eventually do go up, you're going to be hit with a surprise, and what could have been a positive cash flowing property actually becomes a negative cash flowing property simply based on the property taxes. And Cleveland does skew higher in terms of the states from a property tax perspective. So this is just something that you want to be very, very careful with, because I have seen deals that went completely sideways just because they didn't monitor the property taxes. And this is just something. So this is something that I want you to be sure, because it's very different. A lot of states do this very differently, and it's kind of like opaque and very cryptic, and sometimes you might not know. So make sure you talk to your realtor about this, right? Make sure you talk to Mike about this so that we can say, hey, I want to be conservative here, Mike. I want to assume, even if the reassessment is going to be in a few years, I want to assume that it's going to go up. What should I be baking in? So Mike, you want to kind of talk a little bit about this, maybe this property specifically, like what we should be inputting for property taxes?
Yep. Yeah. So I pulled up the property tax bill. So the current property tax bill on an annual basis for this property is $2,866, and it will go up eventually because of the sale. I couldn't tell you exactly when that would happen. So for me, $2,900, that's what, $250 a month. I would probably, for the exercise that we're doing, I'd probably put $300 a month into the tax calculation.
So one thing I also like to do, so right now Mike is recommending obviously a $50 a month bump in terms of what we're assuming here. What I also like to do, and Mike, you tell me if this is bad or not, but I'm going to share this tab instead. There is a smart asset property tax calculator. You can filter to the specific state, and you can actually put in your address here, and you can say the assessed value of the home, Cleveland, Ohio. And then we're buying this for $190,000, right? And it's going to tell you, so this actually is saying, look, this is at a reassessment, right? It's going to be $4,427 for the year divided by 12. So this is actually saying, Mike, this is going to go up to around $370. And so for me, and maybe this is high, but for me, for the property taxes, just to be very, very on the conservative side, right? Let's just bake in that we're actually going to put $325 a month in terms of something. So we're baking in an increase. How much exactly the increase, we don't know, but we want to be conservative, and let's just assume that it's going to go up. Okay, cool. We've gotten to the property tax, and now we have to go through the insurance.
So for the insurance on this building, I think it's going to be a lot lower than you would traditionally see in Cleveland's multifamily market. For one, this property is not that big. It's only 1,900 square feet. It does not have a basement. It does not have a garage. So those are going to factor into the overall cost of your insurance. Plus, this building was built in 1973. Newer construction buildings are they're going to factor less when it comes to insurance. So if I were a betting man, I'm going to say on the very high side, you're going to be no more than $1,500 a year. So Yeah, whatever that calculates out to in a monthly. I think maybe 125.
125. Yeah. So 125. So just over 60 a door, which I think makes sense. I have properties that are kind of like in this range as well. So we're putting in 125 a month. We'll just keep it rolling here, Mike. So gas and electric, typically, right? Gas and electric is paid by the tenants. So we're actually going to put $0 here. Water and sewer, this is a very important point. Depending on where you are, right, in which market you're operating in, water and sewer could be, very ideally, it would be the responsibility of the tenant. But a lot of places, it is actually the responsibility of the landlord. In Cleveland, Ohio specifically, it is the responsibility of the landlord. You are in charge of that water bill. So this is something we're going to put in here. Mike, from my experience, what I've seen, this can depend, but I also think like, $60 to $70 a door makes sense here. So I will kind of want to put in 125 to 150. We could be a little bit more conservative. Let's put it at 150, $75 a door. We'll put it at that. Landscaping here, Mike. I don't know if you have any opinions here. I think, it's not a massive yard. I would kind of want to put in like, I don't know, 50 or $75 a month here, just depending.
Yeah, I think you're going to pay probably $30 to $40 per mow, and it's going to be twice a month. So,
yeah.
And it's only, and you're only doing it eight or 9 months a year. So, if you put in 75, that's more than enough. Yeah.
Yeah. Let's put in 50 because you're right, Mike. You're not going to be doing this. You're not going to be doing this the entire year. Let's just like round it up to 60 here. And so we're kind of rolling through this, ladies and gentlemen. But I just want to kind of like impart on you that this isn't a perfect science. You'll get a lot better at this as you go through, but really just want to kind of hammer home that we are just making sure that we're covering our basis in terms of everything that the property is going to generate in terms of cost, right? So, Mike, I have a line item here for garbage. Now, I kind of also use this as like a catch-all and things like that, but what would you think to put here in terms of garbage?
Well, so in Cleveland, the garbage is in your tax bill. So for this property, you wouldn't have to you could put $0.
Yep.
Now we could always go back and add something to it, but I don't think there's really anything to add at this point.
Yep. Cool. So, and just for the listeners here, like there might be markets where you actually do have to pay garbage, right? And so that's something that is a line item that you should put in there. But for like, as Mike explained for Cleveland, you actually don't pay garbage. That's just baked into your property tax bill. So we don't want to double count costs there. So we're just going to put that at $0. Moving on to more of our variable expenses, Mike. So property management, Mike and I will always say, if you're not a state investor, just get a property manager, right? At most, you're probably going to pay 10% here. And that's usually what I like to input there. And so you're talking about $2,500 a year. The money that you're saving here is just not worth, that's $200 a month is just not worth the stress and headache that you're going to save yourself to just have a good property manager, right? So put in that 10% there, right? And then next, Mike, is the vacancy, maintenance, and CapEx reserves. This is probably the number one thing that I think rookie real estate investors just do not account for. And if you don't account for this, you might say, hey, I'm going to cash flow $280 a month. That's great. But you have to factor in the reserves. If nothing else, to just give yourself the peace of mind that this property can sustain itself over the long term and pay for its own repairs and pay for the months where you don't have vacancy, et cetera, et cetera, et cetera. So you just want to factor these in. So Mike, for the interest of time, because we are deep into this episode here, I like to say, like, let's just put 5% on each of these. And the thing that I'll say here is that might actually be too much. That might actually be too much. For a property that's newer and cleaner, you might not have as much maintenance, right? You might not have as much CapEx and things like that. So this might be something that you toggle, but as a baseline for this property, for example, let's just call it 5% to be conservative. And that means that every single month, you're tucking away $100, you're tucking away $300 a month for a rainy day, right? And so if you have no vacancy, if you have no maintenance, if you have no CapEx, that is your cash flow, right? In terms of like what's coming into your account, but you're just tucking that away and you're treating that as rainy day funds, right? So we're saving more than $300 a month for a rainy day, which I think is great. I think that's a healthy, reserve to be building up from a reserve perspective.
Just for people to understand, we're putting that in there so that you can build those reserves up. In our example, we started with 5,000. So yep. You're not going to want to save a ton more than that, because then you're going to just get an analysis paralysis and never buy a deal.
Yes.
because you're going to feel like, oh my God, I'm never going to make any money. When in actuality, that money is designed to be saved to a certain point, and then it's better off being put into a next deal than it is just to accumulate in a savings account somewhere. So that's all I wanted to throw out.
Yeah, absolutely, absolutely. So like, and also factor that in too, right? Because like Mike is right. We did budget for the reserves. So actually, we might, because we have 5,000 in reserves, we might take these reserves down to 4%, right? We might take these reserves down to 4% because we did budget that 5K. So let's call it 4%, Mike, just because we do have that initial reserve account set up initially, right? And then the last thing, ladies and gentlemen, is our last set of assumptions. And this is also very important, is what is our assumptions on future growth, Mike, right? And so we have to place some assumptions so that we can actually forecast what this property is going to do, because, ladies and gentlemen, it is not about year one results. And if there's anything you take away from this episode, I want to hammer home this. The year one results don't matter. The year two results even don't matter. What really matters is the year, 5 results and onwards, because you have to hold this property for the long term. And these are long-term rentals for a reason, right? If you want to make money in year one, be a flipper like Mike, right? Like this is not designed to be making gobs of money in the initial term. If you want to make a lot more cash flow in year one, flip the property or, focus on short-term rentals. That's what it's going to be designed for. But long-term rentals shine when you hold a property for 5 years or more. So that's kind of what I want to, and to be able to project what this property is going to do in 5 years and beyond. That's where you really need to put in the assumptions, Mike. So in terms of rent growth, I know this from my own experience that Cleveland has had really strong rent growth so far, but we don't want to be too aggressive with this, right? I see people put in really aggressive assumptions here, but if you want to be conservative, rent is going to grow a little bit more than the rate of inflation, right? That's typically what it's going to grow. It's going to grow a little bit more than the rate of inflation. So inflation historically has been around 3%, right, Mike? So like that's kind of where I want to say, if you want to be conservative, 2%. If you want to be a little bit more aggressive, I would say 3%. We can split the difference here and call it 2.5%, right? And this is, again, baking in conservatism. I've had months actually, or I've had renewals at 5%, actually, Mike, in Cleveland, where we've actually been able to bump the rent 5%. But I don't want to count on that, right? I don't want to count on that. You don't want to count on that either, because when you assume 5% and you're only getting 2%, then you get into a scenario where your analysis is not accurate. So I would just say, let's do 2.5% right now. You also have to assume your expenses are going to grow as well. And to be conservative again, Mike, I just assume my expenses are going to grow at the same rate as my income. And so that is what I like to assume. That's just, again, a personal preference. I see a lot of people assume expenses are not going to grow as fast, but with insurance increasing and property taxes and all these things like that, I just like to be very conservative. So I actually hold this constant to the rent growth. And then lastly, for appreciation, same kind of deal here, Mike, right? What do you expect your property to appreciate at? Cleveland's actually been a pretty strong appreciation market as of late, but I also don't like to assume too much here. So I also hold this at kind of 2.5%. Again, this is all personal preference, but at the end of the day, you can make the numbers say whatever you want, but you have to stick to your philosophy. You have to stick to what you really want to stand behind, and you want to feel good about the analysis at the end of the day. So I like to be conservative as possible, right? You can make these things say whatever you want, right? And the spreadsheet's going to spit out whatever you want, but garbage in, garbage out, Mike. And I don't like to do analysis like that. And lastly, Mike, I put in selling costs, because if you do dispo this property, you can't just bank on the fact that you're going to get all that money back. And so what I like to do is I like to input here. And Mike, for all intents and purposes, I see this as being around 7.5% of the total kind of sale price here. And so that's what I like to input, so that you can factor in your true equity in the property, right? Because when you sell it, you're going to have some costs, and you should always have a perspective on your true equity of the property. So Mike, do we feel good about everything we've input here? We can kind of move towards the analysis.
No, I think we built out decent assumptions across the board. So
okay, great. So ladies and gentlemen, now we can go to the P&L here, which is just an analysis of how much cash flow this property is going to generate and an analysis of the returns, right? So at the top here, we have year one, and then it kind of does some skipping because I really like to demonstrate the power of real estate over the long term. So in column 1, we have year 1. In column here we have year 5, but you can also expand upon this. You can see what years 2, 3, 4 do and things like that, right? So if you really wanted to dive into the nuts and bolts of it, you can expand on it. But I always like to tell people it's not about year one, it's about year 5 and kind of beyond for the long-term rental specifically. So that's why I like to kind of collapse the view like this. So the rental income is 2,500 a year, right? And we have all of our expenses lined up here. Our OPEX ratio is 53.4%, which I think is a little high. I think that, what we typically see, especially for a newer property in Cleveland, this should probably be hovering a little bit closer to 50%. But again, this is where we're baking in conservatism, right? We're baking in conservatism into this because we have assumed certain things like that. So we're rolling to a 53%. I like to see this at 50% or lower. If it starts to creep up, Mike, above 55, 60%, you probably have a property that's not worth analyzing further because the operating expenses are too large of a portion of the income, right? So for all intents and purposes, I don't like to see this go too high, but I think for now, that's fine. We have the cap rate here at a 6.2%. And for the listeners, cap rate stands for the capitalization rate. It is the NOI, or the net operating income, divided by the purchase price. We don't have to dive too deep into the cap rate conversation here. In terms of a rule of thumb that I like to kind of follow by, Mike, is I like to see the cap rate higher than the interest rate, right? I like to see the cap rate that's higher than the interest rate because that means you are in a positive leverage scenario. Another way to interpret cap rate is, what's my net return if I bought this property in all cash, right? What is my net return if I bought this property in all cash? And that's a 6.2% return. That's lower than the interest rate. So what that tells me is that, okay, that's red flag number one for me personally on this deal, is that we're in a negative leverage scenario because the cap rate is lower than the interest rate. But we don't have to go too deep there. That's just another thing to kind of analyze there. So now that we have the net operating income, which is just the income minus the expenses, then we have to subtract, obviously, the debt service. And the debt service is the mortgage and the interest payments. So that's roughly $11,000 per year. Another metric I have here, Mike, is the debt coverage ratio. The debt coverage ratio is just out of my NOI, can I service my debt, right? Can I pay for the debt after I subtract all my operating expenses? And right now that's just hovering just over a 1, which means you can pay for your debt service coverage ratio. But personally, I like to see this number a little bit higher, Mike, just so that you have a little bit of wiggle room here. But to remind everybody, we are also subtracting out our reserves, right? So that's about $3,000 a year in reserves. And because we have, if the property is performing well, right, this is not actually a real expense that's going to come to you, but we're analyzing it for conservatism again. So in year 1, we're basically breaking even, Mike, right? We're not really making any money. Again, we've analyzed this conservatively. We're not making any money. It's basically break even from a conservative standpoint. Now, Mike, I want you to kind of talk about this. For me personally, right? And everyone is going to be different here. But for me personally, besides the negative leverage of the cap rate being lower than interest rate, which I don't like to see, we've input reserves. We've been very conservative with everything in terms of like the assumption so far. Seeing a break even number in year 1, I'm not mad at that. Personally, I'm not mad at that. I know that, it's going to improve over time. I know that I've been conservative. I know that I've baked in reserves. A lot of people would be, break even. But for me personally, with my experience and what I know now, a break even in year 1 is not a terrible result.
Is it a home run? No, it's not something I would consider to be a home run. It's hard to quantify too, right? Because 1970s built multifamily and newer, it doesn't come along very often. So, I think you are paying a little bit of a premium based on the age of the property, which at the end of the day, right, if this is about the long-term growth and the long-term rental, the long-term income for someone, it's probably a pretty solid introduction into our market. And once again, we're going to do an inspection, right? So we're going to know exactly what pitfalls we may or may not have to deal with this property. But on the surface, I feel like this is going to be a pretty safe play.
Yeah, 100%. And look, this is why I like to show the forecast view. And this is why I always say year 1 doesn't matter, Mike, because look at what happens over time, right? In year 5, you're jumping up to, $131 a month in cash flow, year 10 at $273, year 15 at $615, or year 20 at $615. And then eventually, right, you're at $1,000 a month in cash flow on this property. And that's not even factoring in the fact that, look, you might be paying down your debt. And what if you can refi, just for purposes of demonstration here? What if the rates drop and you do refi and you can actually get a rate in the 5s? Look at what happens to the numbers when you have a 5% interest rate versus 7% interest rate. These cash flow numbers jump up quite handily. So these are all the strategic conversations that you as the investor have to have with yourself. And you have to think a little bit more beyond year one. Because what is the asset that you're going to want to own for the long term? It is that newer asset that Mike is talking about that isn't going to give you a lot of maintenance problems, that isn't going to give you the headaches. And also, Mike, I'll end with this because we have actually gone to a long episode, but I do think that this is very valuable for the listeners today and everyone watching on YouTube. Cash flow is just one part of your return in real estate. Cash flow is just one part of your return in real estate. And that's what I try to show here. Here is that you do have cash flow, but you also have that debt pay down, right, Mike? Your tenants are paying down your debt and you do have that appreciation. So when you actually add in the cash flow ROI, the debt pay down ROI, the appreciation ROI, your total ROI on an annual basis is 11.3%. 11.3%. Your property value is increasing, your loan to value is decreasing over time. You are 11.3% comprehensive return on an annual basis. That's what you're getting in real estate, right? And that's what you're getting every year. And it's cut up between cash flow, debt pay down, and appreciation. And that ROI is increasing over time, right? Because remember, you're only putting your initial investment into the property is at $58,000, but over time, your appreciation continues to rise, your cash flow continues to rise, your debt pay down continues to get bigger and bigger, right? As your interest gets paid down. And so you were looking at a property that comprehensively is going to be delivering you a very, very strong return. So it is more than just the cash flow. This is why real estate for the longest time has been heralded as one of the strongest investments comparative to the stock market as well, because there's more than one ways to make money. So with that, are we saying that you buy this deal? No, we're not saying that, but we want to arm you with the knowledge and the tools to be able to assess whether or not a deal is worth buying. So I'm going to close this. Again, this is my rental property calculator. You can find this down in the link in the description below. You can also go to cashflowsaga.com/tools. I hope you guys got a lot of value out of this episode. Mike and I are all about trying to give as much knowledge as possible. I hope you learned something about Cleveland. I hope you learned something about deal analysis. If you want to reach out to me, you can do so at Cashflow Saga on all socials. If you want to reach out to Mike, you can find him at Realtor Michael Magno on all socials. We are the Financial Freedom Fighters podcast. We will see you guys in the next episode. Peace.
See ya.